Thank you all for standing by. At this time, I would like to remind all parties that your lines have been placed on a listen-only mode throughout the conference. Today's call is also being recorded. If anyone has any objections, you may disconnect at this time. I would now like to turn the call over to Mr. Daniel Bean. Thank you. You may begin.
Thank you. Good afternoon, everyone, and welcome to today's Risk Analysis Center Banker Teleconference call titled The Community Bank Leverage Ratio for Qualifying Community Banking Organizations. There will be a discussion by our presenters followed by answers to emailed questions. If you would like to ask your question by email during the presentation, please send your questions to rac@fdic.gov. That's RAC@fdic.gov. I would like now to turn this call over to Stephanie Lorick, Capital Markets Policy Analyst, Division of Risk Management Supervision at the FDIC.
Good afternoon, everyone, and thank you for joining us for today's teleconference and webinar. I'm Stephanie Lorick of the Federal Deposit Insurance Corporation, and over the course of the next hour, I, along with David Alps of the Office of the Comptroller of the Currency, Svetlana Phelan of the Federal Reserve Board, and staff of the federal banking agencies will provide an overview of the recently released proposal on the community bank leverage ratio. We will answer any questions emailed prior to or during the presentation after we go through the slides. Today's presentation and a recording of this teleconference will subsequently be made available. Now let's turn to slide 1. The interagency proposed rule that we are discussing today would amend the regulatory capital rule to provide for a simple measure of capital adequacy for certain community banking organizations in accordance with Section 201 of the Economic Growth, Regulatory Relief, and Consumer Protection Act. The proposed rule will have a comment period that closes 60 days after publication in the Federal Register. This teleconference is intended to help interested parties better understand the outstanding proposed rulemaking. Thus, the federal banking agencies welcome any questions today to help clarify the contents of the proposal. The federal banking agencies encourage interested parties to submit any comments on the proposal to the agency's respective public dockets. During today's call, please submit your questions to rac@fdic.gov. That's RAC@fdic.gov. Now please turn to slide 2. The background of the CBLR framework is Section 201 of the Economic Growth, Regulatory Relief, and Consumer Protection Act, which we will refer to as the Act. Section 201 of the Act, titled Capital Simplification for Qualifying Community Banks, directs the banking agencies to develop a community bank leverage ratio, what we refer to as the CBLR, of not less than 8% and not more than 10% for qualifying community banks. Section 201 defines the CBLR as the ratio of a qualifying community bank's tangible equity to its total consolidated assets. The Act further defines a qualifying community bank as an insured depository institution or depository institution holding company with total consolidated assets of less than $10 billion. In addition, Section 201 states that the agencies may determine that a banking organization is not a qualifying community bank based on the banking organization's risk profile. The Act prescribes that this determination shall be based on consideration of off-balance sheet exposures, trading assets and liabilities, total notional derivatives exposures, and such other factors as the agencies determine appropriate. Under the Act, a qualifying community bank that exceeds the CBLR level established by the agencies is considered to have met the generally applicable capital requirements, the capital ratio requirements in order to be considered well capitalized under the agency's prompt corrective action framework, and any other applicable capital or leverage requirements. Further, the proposal would not limit the agency's authority to take supervisory actions consistent with their supervisory authority under the PCA framework or other statutes or regulations. In addition, the Act directs the agencies to establish procedures for the treatment of qualifying community banks that fall below the CBLR level. David Elks from the OCC will now discuss key aspects of the proposed rulemaking.
Thanks, Stephanie. To begin, I'd like to call your attention to slide 3 of the presentation. This slide summarizes the key aspects of the proposed rulemaking. As previously mentioned, the CBLR is an optional framework which can be selected by a banking organization that has less than $10 billion in total assets, has a CBLR that is greater than 9%, and meets certain other qualifying criteria contained in the proposal. If these requirements are met, an electing banking organization would be considered to have met the well-capitalized ratio requirements under the Prompt Corrective Action Framework, as well as the generally applicable capital requirements. The proposal, together with associated reporting requirement changes, would simplify regulatory requirements, thus providing material regulatory relief to community banking organizations that opt into the CBLR framework. Organizations electing to use the CBLR would be subject to simplified reporting requirements, which the agencies intend to propose at a later date. An example of what such reporting requirements may ultimately look like is included in the NPR and at the end of this presentation. Under the proposal, a CBLR banking organization that no longer meets the qualifying criteria would be required, within a 2 consecutive calendar quarter grace period, to meet either the qualifying criteria or comply with the generally applicable capital requirements. During this grace period, the banking organization would continue to be treated as a qualifying community banking organization and would be expected to continue calculating and reporting a CBLR. A CBLR banking organization that no longer expects to meet the qualifying criteria as a result of a business combination should be prepared to fully comply with the generally applicable capital requirements as of the completion of the transaction. Turning to slide 4, to summarize, under the proposal, in order to choose to opt into the CBLR framework, a qualifying community banking organization would be defined as, first, an insured depository institution or depository institution holding company that is not an advanced approaches banking organization or a subsidiary or affiliate of an advanced approaches banking organization. Second, has total consolidated assets of less than $10 billion. Third, a CBLR that exceeds 9%. And finally, the organization must meet the definition of a qualifying banking organization. Because the CBLR framework is optional, a qualifying community banking organization would need to proactively opt into the CBLR framework by checking a box on its call report. As just mentioned, the agencies plan to propose simplified reporting requirements that an opt-in banking organization would complete under the CBLR framework. Thus, a banking organization that opts into the CBLR framework would no longer report all items included in Schedule RCR, thus reducing reporting burden. If, however, a qualifying banking organization does not elect to use the CBLR framework, it would continue to report under the generally applicable capital rules and consequently continue to prepare Schedule RCR. For a banking organization that opts in and later wishes to opt out, the agencies do not propose to place restrictions on the ability of a qualifying community banking organization to switch in and out of the CBLR framework. However, the agencies anticipate such changes to be infrequent and typically driven by significant changes in the bank's business activities. Please turn to slide 5, definition of a qualifying community banking organization. An organization that is not an advanced approaches organization or subsidiary or affiliate of an advanced approaches bank holding company and has total consolidated assets of $10 billion must also meet certain criteria to be considered a qualifying community banking organization. First, off-balance sheet exposures must be 25% or less of total consolidated assets. Second, total trading assets and trading liabilities must be 5% or less of total consolidated assets. Third, mortgage servicing assets must be 25% or less of CBLR tangible equity. And finally, deferred tax assets arising from temporary differences that a banking organization could not realize through net operating loss carrybacks must be 25% or less of CBLR tangible equity. Consistent with Section 201, the agencies proposed these criteria so that banking organizations with higher risk profiles would remain subject to the generally applicable capital requirements. This helps ensure that such banking organizations hold capital commensurate with the risk of their exposures and activities. I'd now like to turn the presentation over to a colleague of mine from the Federal Reserve Board, Svetlana Phelan, who will describe the calculation for the CBLR and compliance with the CBLR framework.
Thank you. Please turn to slide 6, calculation of the CBLR. Under the proposal, CBLR is calculated as the ratio of a firm's CBLR tangible equity, the numerator of the ratio, over a firm's average total consolidated assets, less certain deductions, the denominator of the ratio. CBLR tangible equity would be calculated as total equity capital, not including minority interest, minus accumulated other comprehensive income, AOCI, DTAs arising from net operating loss and tax credit carryforwards, and goodwill and other intangible assets, not including MSAs. Average total consolidated assets would be calculated as the current quarterly average total assets as reported on Schedule RCK, less all the items that are deducted from CBLR tangible equity except AOCI. The inputs for most components of the CBLR ratio calculation would be taken from the current call report schedules. Please turn to slide 7. Compliance with the CBLR framework. Slide 7 provides additional details on compliance with the CBLR framework. In general, a qualifying banking organization that has opted into the CBLR framework and whose CBLR ratio drops to 9% or lower may continue to use the CBLR framework, but it would become subject to restrictions on its activities based on its CBLR level and the associated PCA category. In addition to the well-capitalized CBLR standard, the proposal includes proxy CBLR levels for adequately capitalized, undercapitalized, and significantly undercapitalized PCA categories. If a bank's CBLR is less than 6%, the bank must be able to promptly provide the necessary information to calculate its tangible equity ratio under the current PCA framework. In addition, the appropriate regulators may request the information necessary to determine a bank's tangible equity ratio under the current PCA framework at any time. If a bank's tangible equity ratio falls to 2% or less, it would be subject to the same restrictions as apply under the current PCA framework to critically undercapitalized firms. If a banking organization is no longer a qualifying banking organization due to failing one or more criteria or exceeding the 10 billion size threshold, the banking organization could either opt out of the CBLR framework or use a 2-quarter grace period to meet the qualifying criteria. This grace period is referred to as the cure period. Finally, as mentioned previously, a banking organization that has opted into the CBLR framework can opt out of it. Such banking organization may opt into the CBLR framework again at a future date, but it would need to meet the qualifying criteria and have a CBLR greater than 9%. Please turn to slide 8. CBLR levels as proxies for certain PCA capital ratio categories. Slide 8 summarizes the current PCA capital categories based on the generally applicable capital rule and the proposed CBLR levels, including the proxy CBLR levels for the adequately capitalized, undercapitalized, and significantly undercapitalized PCA categories. For example, if a bank has a CBLR between 9% and 7.5%, the bank would be considered adequately capitalized under the CBLR framework. The bank is also deemed to have met the capital ratio requirements of the adequately capitalized category of the current PCA framework. Now I will turn it back over to Stephanie from the FDIC.
Thanks, Svetlana. Please turn to slide 9. Slides 9 and 10 include an illustrative example of what a simplified CBLR reporting schedule may look like. As mentioned previously, organizations that use the CBLR framework would be subject to simplified reporting requirements and would just need to report their CBLR ratios and the associated components of the calculation. Such a banking organization would no longer fill out the current Schedule RCR, Parts 1 and 2. Now let's turn to slide 11. Let me first start by saying that the agencies would like to thank everyone for their participation today. The agencies also encourage all interested parties to submit written comments on the proposal. Again, the comment period will be open for 60 days after the NPR is published in the Federal Register. Any questions after the call ends regarding this presentation or the proposed rule may be emailed to regulatorycapital@fdic.gov for FDIC-supervised banks, capitalpolicy@occ.tres.gov for OCC-supervised banks, or questions@askthefed.org for Federal Reserve-supervised banks. This concludes our prepared presentation. We will now answer questions received prior to this call, as well as questions emailed to RAC@FDIC during the presentation. Thank you.
The first question that we received was, will standby letters of credit a financial institution has that are issued by another financial institution, specifically from FHLBs, be excluded in the calculation of off-balance sheet liabilities of 25% or less of total consolidated assets for determination of the qualifying bank criteria? The proposal includes all letters of credit in the calculation of the 25% off-balance sheet limit. The only off-balance sheet item that is specifically excluded in the proposal is unconditionally cancelable commitments.
Another question that we had received prior to the call is, will there be any consideration to exclude the dollar value of repurchase agreements for securities sold under agreements to repurchase that are collateralized by deposits on hand in the calculation of off-balance sheet liabilities of 25% or less of total consolidated assets for determination of the qualifying bank criteria? So off-balance sheet repo-style transactions, including repurchase agreements, would be included in the 25% off-balance sheet qualifying criterion to the extent that they are reported in RCL Item 6, securities lent and borrowed. So such exposure would include, for example, repo-style transactions where a bank loans its customer securities and in turn indemnifies its customer. The agencies encourage individuals to submit comments to the extent that on this issue, to the extent that they believe the instructions to RCL Item 6 are unclear.
The next question that we received asks, how does the proposed rule treat banks that are subject to highly concentrated commercial real estate exposure under the 100% and 300% test? Will they still be required to use expanded capital ratios? The agencies, we proposed that standards that currently use Tier 1 capital or total capital should be amended so that for a banking organization that has opted into the CBLR framework, they would instead use CBLR tangible equity instead of Tier 1 capital or total capital. I believe it's question 25 in the preamble to the proposal, where we request commenters' views and concerns on the proposed amendments to affected non-capital rules, and I think this would also be in play in that. It's not in a rule so much, but we would consider comments received more broadly on that, so we look forward to receiving those.
Thanks. One other question we received again prior to the call was, why didn't the agencies choose 8% CBLR requirement instead of 9% CBLR requirement. And I know all the agencies reached out to their research area, and we looked at a lot of data and analysis of various scenarios based upon filings of the banks, and said, with a lot of limits and scenario analysis, and looking at other alternatives, including calibrating the CBLR to 8% were considered. This alternative, though, would allow more banking organizations to opt into the CBLR framework, but would also allow potentially a large number of CBLR banking organizations to hold less capital than under the generally applicable capital requirements. So the proposed calibration of the CBLR in conjunction with the qualifying community banking organization and CBLR tangible equity definitions seeks to strike a balance among the following objectives. We wanted to maintain strong capital levels in the banking system. We wanted to ensure safety and soundness. And importantly, we did really seek to provide an appropriate regulatory burden relief to as many banking organizations as possible.
So another question you received is, can you confirm that TRUPS investments that exceed 10% of common equity will not be deducted from capital under the CBLR framework? So that's correct. Investments in TRUPS will not be deducted from capital under the CBLR framework, as the framework does not include a deduction for investments in financial institutions. Another question that we have is, can you confirm that MSA investments that exceed 10% of common equity will not be deducted from capital under the CBLR framework? So again, that's correct. MSA investments that exceed 10% of common equity will not be deducted from capital under the CBLR framework. However, a bank will not qualify to use the CBLR framework if they have MSA investments greater than or equal to 25% of CBLR tangible equity.
Another question asked, can you confirm that if a bank drops below the 9% CBLR ratio, they will have the ability to opt into the risk-based capital standards? What steps are the agencies taking to ensure examiners are aware of this? So yes, a bank or a banking organization that drops below the 9% CBLR ratio would have the ability and the flexibility to opt in to the risk-based capital standards at any time. So the agencies are currently working with supervisory staff throughout the systems to ensure that examiners are aware of this optionality.
Another question is, what is a major advantage to a qualifying community bank to switch to the community bank leverage ratio? So, the agency's crafted this proposal consistent with Section 201 of the CRAPO Act to implement to propose a simple community bank leverage ratio. The agencies are not in a position to say what the advantages of the framework are. Rather, this is a determination that each individual bank should make based upon its business model. As this is a proposal, the agencies are seeking feedback through the common process on how we can improve the proposal. Another question is, as I understand the CBLR framework proposed rule, those community banks who opt in would be subject to a separate PCA framework than the current PCA framework that all banks are subject to for regulatory purposes. What was the intention behind the separate PCA framework, as it creates confusion as to what standard of capital applies to which bank? So in developing the CBLR framework, the agencies believe that requiring a bank to go back to risk-based capital if their CBLR falls below 9% would limit the burden relief of the proposal. Therefore, the agency set PCA levels below well-capitalized so that a bank whose CBLR falls to 9% or below could continue to stay in the CBLR framework and continue to use the simplified capital calculations and the streamlined reporting schedule, as opposed to going back to a approximately 15-page RCR. In order to provide maximum flexibility, the agencies provide banks with the option to back to risk-based capital at any time. The proposal does include a question as to whether it would be preferable for the agencies to not have proxy PCA levels, but rather include a transition back to risk-based capital, and the agencies encourage commenters to provide feedback on this issue.
The next question we received was, as proposed, the CBLR disqualifies banks that have MSAs, mortgage servicing assets, greater than 25% of capital. Banks are concerned about the cliff effect this creates for institutions that qualify for CBLR for several years, but then have MSAs that exceed 25%. Such banks would face an abrupt reversion to Basel III or its progeny, which could have material capital implications. Are the regulators amenable to using the same exclusion methodology in Basel III that would allow a bank to continue to qualify for CBLR but exclude MSAs greater than 25%? This change is simple and consistent with the 25% exclusion level in the 2017 proposed changes to Basel III that will be finalized soon. That is the question. So I think on this we have asked questions about the treatment, and we would seek to just collect your comments on that particular aspect of the rule. We would consider that in conjunction with the treatment in the generally applicable rules as well.
So I ask people on the line to be patient as we're going through a lot of questions and allocating them and coming up. We've got quite a good feedback from everyone, so be a little patient. We work through it. One question we have is, will there be only one time to opt in for this, or can banks do this at any time? And the answer is, we will permit banks to do this at any time. You don't have to opt in when the call report first offers that option, as long as you meet the qualifying criteria and appropriate CBLR ratio. It's really up to the bank's discretion.
So another question that we have is, when was the CBLR proposal published in the Federal Register, and then when does the comment period end? And the answer to that is it has not yet been published in the Federal Register. Hopefully that'll happen over the course of, potentially the next few weeks. And once it is published, there's going to be a 60-day comment period.
Another question that was asked, if the ratio is set at 9% in 1 quarter, a firm falls below the 9%, even slightly below, would that firm have a grace period to get back over the 9% before sanctions, is how the question is asked. We would highlight that falling below 9% does not disqualify a firm from the CBLR framework, and so that is not a disqualifying criterion. Therefore, a grace period would not be needed in this case. The only time that a firm would be disqualified from the CBLR framework is if it fails to meet the qualifying criteria themselves. For example, if it exceeds the off-balance sheet filter of 25%, and so forth. And so a firm can remain in the CBLR framework with a CBLR of less than 9%.
Yeah, and just to supplement that, the bank would not be well capitalized, however, if it falls below 9%. So it's under the proposal, it would fall to adequate. For PCA purposes, it would fall to adequately capitalized based on its capital ratio.
Next question we received says, if the individual banks within a holding company are each less than $10 billion in assets, but the entire holding company is greater than $10 billion in assets, can the individual banks opt in and not complete RCR? The answer to that first part is yes. Will the holding company have to fill out the RCR on the Y-9? And the answer to that is yes. For both of these questions, I would just re-note what we said during the formal presentation, that if you're an advanced approaches banking organization under the rule, you would not be eligible regardless of your asset size.
Okay, so another question we have is, for a bank that opts in, meets the 9% threshold, and otherwise meets the well-capitalized characterization, does this rule impact the FDIC's ability to determine that a bank can be deemed less than well-capitalized by virtue of a capital clause in an order? The answer to that is no. So in the existing PCA framework, there is the clause that in order to be well-capitalized, the bank must not be subject to any written agreement, order, capital directive, or prompt corrective action directive issued by the FDIC pursuant to the FDI Act, the International Lending Supervision Act, or the Homeowners Loan Act, or Section 38 of the FDI Act, or any regulation thereunder to meet and maintain a specific capital level for any capital measure. And in the PCA framework for the CBLR, we've carried over that exact same requirement. Another question is, if the agencies consider a bank's risk profile to define a qualifying bank, how will those requirements be communicated to the bank? So the requirements to be a qualifying community banking organization, so those are included within the definition of a qualifying community bank. They're described in the proposal, also in the rules text, and in the simply illustrative reporting schedule that's also included in the proposal. And the thinking here is that those requirements would be part of the reporting that we hope to propose in the near future. So as part of its reporting process, a bank would be reporting and updating its qualification against the proposed definition.
There's a question about what are the benefits to opt in other than having less schedules to complete. There's a number of benefits that a bank might find, and I think each bank would have to evaluate based on its facts and circumstances. However, a bank that uses the CBLR framework would have a simpler calculation of its numerator for capital measure. It would have to calculate fewer capital ratios. It would not have to calculate risk-weighted assets, and it would not necessarily be subject to changes that may occur to the generally applicable risk-based capital rule, so that it would have a separate framework that would not necessarily change when there was a change to the risk-based capital framework.
Another question is, what are the Basel capital buffer implications of this proposal for opt-in versus opt-out banks? So if you opt into the CBLR, the capital conservation buffer included in the current capital rule would not be applicable to you. So you'd be relieved of that requirement.
We have another question. It says, we have a $91 million enclosed 1 to 4 family mortgage securities that we service for Fannie Mae. Our total assets are $180 million. Am I correct in figuring that we would not be able to opt into the CBLR capital framework because our servicing assets, and the question reads, exceeds 25% of our total assets? The question continues, we'd like to be able to opt in. Is there a way to opt in with the amount of assets we are servicing for Fannie Mae? And, you know, the answer to this is first, well, it's no, but our ratios or our criteria looks to the tangible equity number. And I would also, just at this moment, say we're giving you the answers to how the current NPR is proposed to help inform you to color your comments and inform them. So if there are situations where you feel the rules should be amended or the proposal should be amended, please feel free to include that in your comments. Thanks.
There's a question asking whether the treatment of DTA, net operating loss carryforwards, will change relative to the current risk-based capital treatment and the generally applicable rule, capital rule. And the answer is the DTA carryforwards today for NOLs, net operating losses, are deducted from Common Equity Tier 1, and that similarly they would not be included in the measure of tangible equity under the CBLR framework.
There was a question. Will bank holding company trust preferred securities that currently qualify as Tier 1 capital continue to be included as tangible equity? So in general, the calculation of CBLR tangible equity starts with item 27.A on Schedule RC, total bank equity capital. So to the extent instruments are included in that item, it becomes part of the calculation, and there are no additional deductions for trust preferred securities.
So there's another question which asks, how is the off-balance sheet 25% threshold calculation performed, again, to total consolidated assets? So, you know, I encourage folks to make sure they go through the rules text. But what the rules text says is you sum up the notional amount of the following exposures. So the unused portion of commitments, except for unconditionally cancelable commitments. Self-liquidating trade-related contingent items that arise from movement of goods, transaction-related contingent items, including performance bonds, bid bonds, warranties, and performance standby letters of credit, sold credit protection through guarantees and credit derivatives, credit-enhancing reps and warranties, securities lent and borrowed, calculated in accordance with the reporting instructions to Schedule RCL of the call report, financial standby letters of credit, forward agreements that are not derivative contracts, and off-balance sheet securitization exposures. So the notional, you sum up the notional amounts of these of those lists, those set of exposures, and divide that by your total consolidated assets. And if it's less than 25%, you meet that qualifying criterion. And and related to this, and all aspects of the NPR, we encourage folks to submit in comments to the extent some portion of the NPR is not clear, a term, the definition of a term is not clear, or some reporting instructions are not clear. We encourage folks to provide us that feedback through comment letters so that we can take that into consideration as part of the final rule and incorporate any clarifications that are needed.
Another question we got in determining, relatedly, is in determining the off-balance sheet qualifying criteria, is the expectation to align the figures with the off-balance sheet items reported in HCR or HCL. The proposed off-balance sheet exposures would generally be consistent with off-balance sheet items that are reported in Schedule R for generally applicable capital requirements, except for securities lending and borrowing. These exposure amounts, or off-balance sheet exposure amounts, are derived, I would expect, mostly from RCL, but they don't necessarily all align perfectly with RCL. So to the extent that this is an issue or concern, I would recommend you comment and ask for clarification, and if you have a preference or think that one way is better, there's a better way of doing this, please, you are encouraged to advise us of that too. Thank you.
Another question we have is, when will the opt-in option be available for the bank on the call report? So we're in the proposal stage, so obviously we have to go through the 60-day comment period, take your comments into consideration, and then finalize the rule, which potentially would be sometime next year. And then the thinking would be around the time that we finalize the rule, we'd also want to have the reporting schedules updated at about the same time. It's hard to say with specificity, but it potentially is going to be next year sometime.
Oh, we got a question. How is the ALLL treated for purposes of calculating the CBLR? And because the CBLR doesn't include Tier 2 capital or total capital, it's a measure of tangible equity. And ALLL is included in Tier 2 capital and is treated, has a specific treatment under the, it has a specific treatment under the risk-based capital framework. It does not really have a specific treatment under the CBLR framework. So ALLL is not used for purposes of calculating the CBLR ratio.
So the next question we got was it's a bit extensive, but I'll try to paraphrase it. It's basically asking what the status of our previously issued proposal was that we sometimes refer to as the Simplifications NPR, and some of the things that were part of that proposal that was issued in September of 2017 had to do with regulatory capital deductions, the high volatility commercial real estate treatment, and then some other deductions dealing with MSAs. And the question asks, when will this NPR be addressed, especially given the 25% maximum on MSAs with respect to the CBLR, while the MSA cap under Basel III remains at 10%. I think at this point, the most I can say on that is that the agencies are evaluating the interactions of the two and don't have any specific timing that we can tell you on this, but it is something that we're looking through and understand that there's a desire to have certainty around what the treatment is under that rule. The other thing that I would say is we have a reproposal out there, given that the passage of the Act affected the high volatility commercial real estate treatment and had sort of a different definition, so we're also evaluating it in terms of that proposal. I don't think any agency can commit to speaking on behalf of what their agency would actually do, because we can't prejudge the actions of our boards and our principals, but staff is actively looking at these.
I have a relatively straightforward question. If a bank has a 9% leverage ratio, do they qualify? The proposal says banks that exceed 9%. Please clarify, thanks. It is for banks that exceed 9%, and we had a lot of discussion in developing the rule, so this language is very intentional. And, you know, feel free to raise that in the comments, but it's not equal to, it's in excess of 9%.
I would just add to that, I think the agency's read of that is that having it exceed 9%, at least as an initial matter, is consistent with the statute, at least our read of the statute. But again, please feel free to comment on it.
Another question is, will the CBLR calculation be included on each call report? So the current thinking of the agencies is that yes, you would have a quarterly CBLR schedule, somewhat similar to the illustrative reporting schedule that you see in the preamble to the NPR and that you saw in the presentation today.
There's a follow-up question in addition to the question we responded to before. Again, about including TROPS. There's, correctly pointing out that TROPS are the holding company line item, so they would not appear on the call report. So with holding companies, the situation is similar. The item 27.A on Schedule HC is the starting point for the calculation. So apologies for the wrong citation. Thank you.
I think that's the extent of the questions that we've received thus far. There may be a couple that we've received that we have to take more of a technical look at. So if you asked a question and you didn't get an answer to it, it may be that we have to look into it a little bit more and we can get back to you via your email. But I think that's what we have so far. But give us a minute and we'll see if any others are flowing in.
Here's a question that asks that the institution says it seems it would have less room between the CBLR and the regulatory minimum for well-capitalized than we would under the current capital rules. In other words, including the buffer. In fact, we would need a Tier 1 capital ratio of roughly 12% or more. And that's possible. Of course, the CBLR doesn't include any off-balance sheet items per se. What it does have a filter for off-balance sheet exposures. And we, in calibrating the CBLR, took into consideration that we would not be capturing off-balance sheet exposures in the ratio. So for some banking organizations, they will find that they will have less headroom between well-capitalized and their actual ratio. Some might have more headroom. But to the extent banks think that the calibration should be adjusted or any other changes should be made, again, we encourage you to submit comments.
But we've gotten a lot of questions asking about asking if people could obtain a copy of the slides. And following this call, we're going to make a copy of this webinar available on our external websites, along with and you're also able to get a copy of the slides. It'll probably take a few days in order for us to get a copy of the webinar and to upload this information, but it should be available at the FDIC Regulatory Capital external website.
I think that concludes the call. I want to thank everyone for their questions. Again, we encourage everyone to submit comments as part of this rulemaking. It's very valuable to us, and thanks again.